Hey, hey, hey. Welcome back to Sip&Talk. I'm Joe.
Good morning, good afternoon, good evening. Wherever you are in the world, I'm Sunny.
Do you have your coffee ready today?
Oh, absolutely.
I do, and mine is particularly strong today. I feel like it's bracing me for the kind of market volatility we're about to discuss.
I hope it gives us the clarity to navigate exactly what's happening on Wall Street, because we are starting with a major punch today. The three words Wall Street hates to hear right now have returned. Michael Burry is shorting.
Right. We're talking about the infamous investor who accurately called the subprime mortgage crisis the big short guy.
Mm-hmm.
For a while, we thought maybe he used up his most aggressive moves, but now he's targeting the biggest story in the market, AI.
The timing couldn't be more sensitive. Tech stocks have been soaring to, absurd valuations on the back of the AI narrative. And Burry isn't just taking a small position. He's betting over $1 billion that AI stocks are about to become the next burst bubble.
And this is what shocked everyone. The concentration. His short positions in Palantir sitting at about $900 million and NVIDIA around $200 million. That makes up nearly 80% of his entire investment portfolio. This isn't hedging. This is a full conviction bet.
It forces us to ask the central question, and it's a terrifying one for a lot of investors. Is Burry seeing the inevitable collapse of a massive speculative bubble? Or is he fundamentally missing the beginning of the next 10-year technology supercycle, just standing on the sidelines as the train leaves the station?
That is the core of our discussion today. So we're going to unpack Burry's precise logic, the so-called accounting tricks, and fake demand he's pointing to.
And then we're going to use real metrics and data from NVIDIA and other sources to strongly counter his bear thesis. We'll assess if this widespread market fear, combined with high interest rates, is actually creating, a once-in-a-lifetime long-term buying opportunity.
We also need to look beyond the stock prices and examine the structural reality of the global economy. How entrenched is this low-growth trap we're stuck in? And how does AI become the necessary condition, not just a luxury, to break that global inertia?
And finally, we're diving into the AI arms race itself. We'll analyze Google's massive strategic shift with their custom TPU chips and the revolutionary Gemini 3 model, and then connect all of this back to the crucial physical constraint, the AI-driven power consumption crisis that's hitting global infrastructure.
Ready to jump in, Sip&Talkers? Let's hope we can save you hundreds of hours of research time and give you the nuggets you need.
Let's get into it.
Okay, let's unpack Burry's bear thesis. He's not arguing that AI is worthless. He's arguing that the numbers currently supporting these sky-high stock prices are fraudulent, or at least heavily manipulated. And he has two primary arguments, both of which are pretty aggressive.
That's right. The first argument is highly technical, and we can call it the depreciation issue, or maybe the accounting trick.
Okay, explain this to the average listener, because depreciation sounds boring. But in this context, it sounds, explosive.
It is explosive. Burry is alleging that the major cloud and AI infrastructure companies, we're talking about Amazon, Google, Microsoft, and Meta, are systematically underestimating the depreciation of their highly expensive AI chips, specifically the GPUs.
How do they do that?
They do this by claiming these chips have a much longer useful life than they realistically do. A chip might typically be amortized, say, over 4 or 5 years. But they are extending that period to 7 or even 8 years.
So if I buy a massive $50,000 GPU cluster, instead of spreading that $50,000 cost over 5 years, which means $10,000 in cost hits my books every year, I spread it over 10 years, meaning only $5,000 hits my books annually.
Exactly. You are pushing the operational cost of that capital expenditure further out into the future, and the immediate result is an artificial inflation of your current period profits. Burry suggests this accounting maneuver alone could be inflating the reported earnings of these infrastructure giants by over 20%. If that's true, the market's premium valuation, which is tied directly to earnings growth, is built on a foundation of sand.
That's a powerful accusation because it affects all the hyperscalers, not just NVIDIA. NVIDIA sells the chips. But the hyperscalers are the ones reporting the inflated profit margins because they are using these elongated depreciation schedules.
Correct. And his second argument is even more damaging because it targets the actual demand structure. He calls it circular deals, leading to fake demand. He believes actual genuine end-user demand for AI, meaning, consumers or small businesses paying for services, is ridiculously small.
So where is the explosive revenue growth actually coming from then?
According to Burry, the growth is mostly driven by an internal corporate hot potato. It's a closed loop where AI model makers, cloud providers, and semiconductor companies buy software or hardware from each other. They're effectively just trading cash or cloud credits back and forth.
Give us a concrete example of this hot potato. How does that work?
Okay, picture this. Company A, a large AI model maker, needs infrastructure. They get a massive credit line from cloud provider B. Cloud provider B, in turn, uses that cash to buy hundreds of thousands of chips from semiconductor company C. Then, company C turns around and pays company A to use its AI models or buys their software. The cash is circulated, allowing all three entities to report massive revenue growth, yet no external consumer or business value has truly been generated to support that initial expense.
So the corporations are basically playing a game of musical chairs with cash just to inflate their top-line revenue numbers, and to maintain the illusion that this massive infrastructure build-out is being justified by external market demand. If that's his thesis, that is the definition of a speculative bubble divorced from underlying fundamentals.
It is. These are sharp, experienced accusations from a veteran short seller. But we have to turn to the other side, the bull counter-argument, because the data and the technological momentum coming from NVIDIA and the hyperscalers are equally formidable.
Okay, let's start with the counter to the depreciation issue. How can NVIDIA justify claiming their chips last 7 or 8 years in a data center environment where technology gets obsolete in, months?
So NVIDIA's defense is centered on software longevity. They continuously extend the functional lifespan of their GPUs through sophisticated software updates, specifically mentioning systems like Tensor RTLM, which stands for Real-Time Learning Machines.
Tensor RTLM, what does that do in simple terms?
Essentially, it's just advanced software optimization. When you buy a GPU, say an H100, the hardware remains fixed, right? But NVIDIA's software stack, through successive updates, makes the use of that fixed hardware much more efficient for modern AI workloads. They are constantly tweaking how the core communicates, how memory is allocated, and how matrix operations run.
So it's kind of like having an old car, but the manufacturer releases a secret software update that makes the engine twice as fuel efficient and powerful. The hardware is old, but the performance metrics are modern.
Precisely. Therefore, NVIDIA argues that a longer depreciation schedule isn't an accounting trick. It's an accurate reflection of the asset's useful economic life, which is being extended by proprietary software innovation that competitors can't match.
That addresses the accounting trick, but what about the fake demand claim? How do the bulls prove that real external demand actually exists?
The most direct counter is the sheer user-based data. Burry claims end-user demand is ridiculously small, but we have ChatGPT data. It boasts approximately 800 million weekly active users.
Hold on, 800 million weekly active users. That is roughly a tenth of the global population.
It is staggering. You cannot, in good faith, categorize a service used actively by 1/10 of the world's population as having ridiculously small demand. Those millions of users are performing queries, generating data, and consuming immense amounts of computational resources, which translates directly into real-time demand for GPUs and cloud services.
And if the revenue was truly just based on internal circular deals, NVIDIA's recent financial performance would be, inexplicable. They just posted quarterly revenue of $57 billion. That's a 22% increase quarter over quarter and a breathtaking 62% jump year over year. Their earnings per share, their EPS, rose 67% year over year.
Those numbers are explosive, and they defy the idea that earnings are purely phantom or generated by internal swaps. While some circular deals might exist, which is standard practice in vendor-client relationships in any capital-intensive vertical, they cannot possibly account for the magnitude of this growth. It requires massive external substantive demand.
And let's not forget the crucial element that really solidifies NVIDIA's dominance, the network moat. This is where the bull case moves from defense to offense.
Absolutely. A growing chunk of NVIDIA's data center revenue, currently sitting at about 16%, comes from its high-speed networking technology, specifically Spectrum-X Ethernet and NVLink. This network segment grew by 164% year over year.
Why is that growth rate so important? I mean, it sounds like dry infrastructure stuff.
It's the infrastructure that dictates performance. To train massive models, you don't just need thousands of GPUs, you need to connect them so they can share data instantly, acting as one giant cohesive brain. NVIDIA isn't just selling the car, the GPU, they are also selling the high-speed highway system, the network fabric that makes the whole operation work efficiently.
And the moat part.
because this makes NVIDIA, de facto, one of the world's largest high-performance networking businesses. And critically, this networking component, the switches, the interconnects, can be upgraded independently of the AI chips themselves.
I see. So a company can buy H100s today, and 3 years from now when the H100s might start to lag, they don't have to rip out the entire network infrastructure. They can just upgrade the network fabric with newer NVLink technology to boost efficiency for the existing chips.
Exactly. This drastically extends the overall effective lifespan of the entire data center investment, further validating a longer depreciation timeline and cementing the hyperscalers' investment in the NVIDIA ecosystem. Regardless of who else makes a competitive chip, it's an end-to-end solution lock-in.
So we have Burry's potent warnings about overvaluation versus the powerful data backing real demand and technology lock-in. What does this mean for our listeners who are long-term investors?
It means maintaining composure and leveraging opportunity. Long-term investors should view market-wide fears, whether driven by high interest rates or the short selling of famous figures like Burry, as a potential once-in-a-lifetime investment opportunity.
Right. We have to remember the core principle here. It's Buffett's principle. Be greedy when others are fearful and fearful when others are greedy.
And where is the market right now? If we look at the CNN Fear and Greed Index, it has been hovering consistently in the extreme fear zone. That emotional state of the market is usually indicative of deep value being available, even if the absolute price looks high.
This gives us an actionable strategy. When the market momentum truly breaks, when the S&P 500 breaches a critical support line like the 125-day moving average, and volatility, measured by the VIX index, spikes to 30 or higher, that signals extreme panic.
That is the time for aggressive, systematic dollar cost averaging. The structural value of hundreds of billions of dollars in AI infrastructure, built by the world's largest, most stable corporations, is not disappearing overnight. We are simply waiting for market sentiment to offer us a more palatable entry price, which is exactly what Burry's actions are helping to create.
The certainty of AI technology's long-term value is solid. The risk lies solely in the short-term price volatility caused by macro factors and, market hysteria. We need to distinguish between the two.
We just discussed Burry's financial concerns, but now we have to shift to a much more fundamental physical constraint that might impact AI expansion sooner than any accounting scandal. And that's AI's voracious power appetite.
This is the hidden choke point in the AI race. The data shows that for nearly a decade and a half, between 2005 and 2020, U.S. electricity demand was relatively flat. The economy was just getting more efficient.
But since 2020, primarily driven by the exponential growth of AI data centers, U.S. electricity demand is spiking dramatically again. This is a massive structural reversal in energy consumption patterns.
The forecast is startling. U.S. electricity demand is projected to grow by approximately 25% over the coming decade. Think about what that means for our aging grid.
And here's the reality check. Despite all the exciting talk about clean energy, the power sources meeting most of this immediate AI-driven growth are still natural gas and coal. These traditional sources are expected to be the main providers of new capacity over the next decade because clean energy deployment cannot keep pace with AI demand right now.
That is a major sustainability dilemma that often gets ignored in the hype. And speaking of capacity, the other massive problem is the infrastructure bottleneck created by broken permitting processes.
It's a tragedy of bureaucracy. High-level energy and infrastructure executives are openly stating that the time required to secure a federal permit for new infrastructure in the U.S. now takes longer than the actual time needed to build the facility itself, whether it's a new pipeline or a transmission line.
That is just mind-boggling inefficiency. We have the technology, we have the capital, and we have the clear demand from AI, but the administrative process is the ultimate throttle on progress.
And who ultimately pays for this inefficiency and surging demand? The consumer. We are already seeing the consequences in regions dominated by data center growth. Wholesale electricity prices in those areas have soared by up to 267% over the last 5 years.
267%. That's not a marginal increase. That's a crippling cost shock for businesses and families.
This pain, however, is catalyzing a powerful shift, what you could call a consumer-led energy revolution.
That's a great phrase. We see it happening in the residential market. Companies like Sunrun, the largest residential solar and battery company in the U.S., have shifted their focus to storage first.
And why? Because consumers are actively seeking independence. They want insulation from two things: increasing grid outages caused by instability and the rapidly soaring costs. By installing solar paired with batteries, they're effectively creating their own microgrids.
It becomes a critical infrastructure purchase, not a luxury. If your power bill is up 267% and your grid fails regularly, investing in a home battery system is suddenly an economic and security necessity.
And this also taps into the national security angle. Since much of the current large battery supply chain relies heavily on China, new legislation is aiming to shift the market towards domestic or allied non-Chinese supplied large batteries to ensure economic and national security robustness.
This physical crisis, the power crunch, is a fantastic segue into discussing how Google is executing its counterstrike in the AI arms race. They're attacking the constraint of power and cost through hardware.
That's the core of Google's strategy, their Tensor Processing Unit, or TPU. This is an application-specific integrated circuit, an ASIC, optimized specifically for the massive matrix and tensor operations fundamental to deep learning.
And the key difference isn't raw speed. NVIDIA often wins on maximum FLOPS, floating point operations per second. But Google is focused on something else entirely.
They focus on achieving a superior performance-to-power ratio and drastically lowering the total cost of ownership, or TCO, for long-term inference and training. In the world of hyperscalers running models 24/7, TCO, which includes power draw, cooling, maintenance, and chip, cost trumps peak FLOPS every single time.
Historically, Google's business model was highly vertically integrated. They only rented TPUs via Google Cloud. They kept the chips locked inside their data centers. But now, that strategy is fundamentally changing.
This is the critical shift that breaks the mold. We have seen definitive evidence that Google has begun selling TPU v6 chips to Anthropic. They are breaking the pure rental model.
This isn't just a simple client deal. This move suggests Google is willing to enter the chip sales market, potentially selling raw silicon, or even more aggressively, selling full compute cluster solutions.
Exactly. The future potential is significant, selling complete compute clusters that include their proprietary chip interconnect technology, their ICI. This would position Google not just as a cloud provider, but as a direct infrastructure supplier, directly challenging the existing supply chain monopoly held by NVIDIA and AWS.
But let's be clear, this is not an all-out declaration of war against NVIDIA. Google is operating a dual-platform strategy. They recognize that TPU and NVIDIA GPU are coexisting, not conflicting.
They have to. The power of the ecosystem, particularly the CUD developer lock-in, is too strong to ignore. Developers are trained on NVIDIA's toolchain CD, cuDNN, and the vast cross-cloud ecosystem relies on NVIDIA hardware compatibility.
So Google's internal calculus is brilliant. They use TPUs internally to lower their operating costs for core services like search, ads, and YouTube recommendations. But Google Cloud must continue to heavily support and sell access to NVIDIA H100s and future Blackwell chips to cater to the broader market and maintain that crucial developer loyalty.
It's just smart business. They are optimizing their own P&L with TPUs while remaining a competitive open vendor in the cloud market with NVIDIA hardware.
Now, for a quick nerd moment, because the specs back up the TCO claim, the latest Ironwood, the V7 TPU, is seriously powerful.
Yes, the Ironwood TPU boasts 4,614 TFLOPS per chip and can scale up to 9,216 chips per pod, achieving a peak performance of 42.5 exaflop-PS. That is an almost incomprehensible amount of parallel processing power dedicated purely to AI.
And that efficiency translates to the bottom line. Specialized AI workloads have demonstrated that TPU performance per dollar can be up to 4 times that of general-purpose GPUs, thanks to that TCO advantage. This is the structural force driving hyperscalers to invest heavily in specialized hardware, justifying the massive capital expenditure Burry is scrutinizing.
Speaking of structural forces, the technological breakthrough that truly acted as a catalyst for Google recently was the launch of Gemini 3. This was more than just an update. It was a demonstration that Google has not just caught up, but potentially leapfrogged its rivals.
And critically, this breakthrough validated their hardware strategy. Gemini 3 Pro was trained entirely on their proprietary TPU v6 architecture. It proved that their custom silicon could indeed produce world-leading frontier models.
The results were definitive. Gemini 3 Pro completely surpassed key rivals, including OpenAI's rumored GPT-5 and Anthropic's Claude Sonnet 4.5 in major industry benchmarks. It achieved an astonishing 1501 ELO rating on Elmarina, solidifying its place as a top performer.
The qualitative leap is what's fascinating. The model moved beyond simply reading text and images to being able to understand the entire context across modalities. It is truly multimodal.
And this gave it revolutionary agentic capabilities. This is the next phase of AI development. The model can autonomously plan, reason, and execute multi-step tasks toward a user-defined goal, which drastically reduces the need for human intervention in complex workflows.
And we have to mention the huge context window, 1 million tokens. To put that in perspective, that allows the model to analyze and retain the equivalent of an entire 1,500-page novel or dozens of complex corporate reports simultaneously. That's invaluable for enterprise adoption.
Wall Street reacted instantly. Gemini 3 acted as a major catalyst for Alphabet stock.
The GOGL stock surged over 6%, breaking the $300 psychological barrier and hitting a new all-time high. Analysts were quick to raise their price targets toward $350, recognizing that Google successfully closed and perhaps temporarily eliminated the technical gap with its competitors.
Their strategic clarity on monetization was also key. Google immediately deployed Gemini 3 into their core businesses: search, their massive advertising systems, and cloud services. They are not waiting to monetize the innovation. The market loves seeing a clear path to return on investment.
And we can't ignore the massive vote of confidence from the ultimate long-term investor. Berkshire Hathaway's surprise $5 billion bet on Alphabet. When Burry is shorting Palantir and NVIDIA, and Warren Buffett is backing Google, it creates a fascinating tension about long-term versus short-term value.
It's a powerful endorsement of Alphabet's enduring market position and its ability to turn massive R&D spending into concrete products and profits.
So we have this incredible burst of technological innovation and market valuation in Silicon Valley, but we have to pull the lens back and look at the global economic landscape, which is facing a much darker structural reality: the low-growth trap.
This is crucial. We must look beyond the tech stock hype and recognize that the slow growth the world is experiencing is structural, not merely cyclical.
The consensus forecast from major bodies like the World Bank and the OECD shows global growth stabilizing at a modest 2.7 to 2.9% for 2025-2026.
And that rate, frankly, is considered insufficient. It's too low to support sustainable development goals, particularly in effective poverty reduction across the globe. We are stuck in a slow-motion, steady state.
This low-growth trap is reinforced by a series of structural headwinds. We are dealing with persistent inflation pressures, historically high trade policy uncertainty, rising tariffs and trade barriers globally, and of course, grinding geopolitical tensions.
Geopolitics is especially damaging here. We've seen that the collective GDP of the BRICS economies, when measured by purchasing power parity, has now surpassed that of the G7 nations. This ongoing shift in global power equilibrium increases fragmentation and makes coordinated global policy decisions incredibly difficult.
And let's not forget the investment gap. Business investment has remained weak globally since the 2008 financial crisis. This lack of robust capital expenditure prevents economies from effectively absorbing and utilizing transformative new technologies like AI. They simply don't have the modern machinery to leverage the AI software.
This is why AI moves from being a luxury to being the required cure. It is the necessary condition to break this structural low-growth inertia.
The numbers here are truly mind-blowing. Analyst estimates suggest that if at least half the world's companies widely adopt generative AI, global GDP could see an additional annual increase of 7% over the next decade.
7% additional growth annually equates to roughly $7 trillion injected into the global economy every year. AI achieves this by dramatically boosting total factor productivity, making capital and labor work smarter, not just harder.
In the U.S. labor market, Goldman Sachs projects that AI could boost labor productivity by 1.5 percentage points annually over a decade. Compare that to the 1.3% average growth seen in the previous decade. AI is literally the productivity engine we've been waiting for.
However, we can't ignore the human cost in the transition. While technology historically doesn't cause mass unemployment, it shifts. Employment AI will cause significant skill mismatches.
Right. Certain job functions will be eliminated or drastically altered. The key challenge for governments and businesses isn't to prevent AI adoption, but to immediately prioritize education, reskilling, and training programs to move the displaced workforce into those newly created higher-value roles. That skill mismatch, not unemployment, is the biggest immediate labor risk.
Let's synthesize everything now. We started with Burry's bear case, validated the underlying technological leap with Google and NVIDIA, and established that AI is macroeconomically necessary. This leads us to the valuation paradox, the disconnect between technological certainty and market risk.
Right. We must differentiate. The AI tech value is solid. AI is a structural force that increases total factor productivity and profitability, or return on capital. This justifies long-term structural optimism about the technology itself.
However, AI stock prices are risky. The price of the stock is the bubble, not the underlying technology. European central bank officials have openly warned about the alarmingly high valuations in the U.S. tech sector. The market has priced in not just 2 or 3 years of future growth, but potentially a decade of future earnings.
This creates an extreme vulnerability. Investors are questioning if the massive capital expenditures these companies are incurring, the very capex Burry is watching, will deliver the ROI necessary to justify the current stock prices within a reasonable time frame.
And this valuation buoyancy exists despite record-high geopolitical and economic policy uncertainty globally. This disconnect is unsustainable.
It means market sentiment is highly fragile and vulnerable to a sudden shift, a seemingly minor macro disappointment, a higher-than-expected inflation print, or a major geopolitical escalation could easily trigger the sharp market correction Burry is betting on. The risk is that the market realizes the ROI timeline is much longer than the current price suggests.
So the investing takeaway is, focus on companies that prove they can embed AI deep into their core business for structural efficiency gains, like Google has with search and ads, rather than just following the concept stocks.
Now let's pivot to the final major risk, which is non-financial, the geopolitical mess and stalled global governance.
The speed of the AI revolution is fundamentally decoupled from the speed of global rulemaking. The current geopolitical tensions, particularly the U.S. policy of blockading China's advanced AI development through chip export controls, have severely fragmented the global AI governance discussion.
The debate is stuck in ideological confrontation, where nations are more focused on defining strategic dominance than on addressing the real shared risks like deepfakes, large-scale disinformation campaigns, and fundamental privacy erosion.
And while the politicians argue, the technology moves at exponential speed. Computing power used to train state-of-the-art AI systems has increased a staggering 55 million times over the past decade.
55 million times. It's an impossible scale for human regulatory bodies to grasp. This pace is terrifying experts who worry that without swift global safeguards, we risk losing effective control over the most powerful AI systems by the year 2030.
In this regulatory vacuum, businesses need certainty. Since global consensus is stalled, the EU AI Act has effectively set the global gold standard, a phenomenon known as the Brussels effect. Multinationals must comply with the EU's laws to operate in the world's largest single market, making it the de facto global regulation.
And the EU AI Act provides a very clear compliance roadmap, which is exactly what businesses need to plan capital expenditures. It mandates a series of immediate bans starting in February 2025.
These bans are crucial for ethical boundaries. They include the prohibition of scraping web or CCTV images to create facial recognition databases indiscriminately, inferring emotions in educational or workplace settings, and using AI for harmful manipulation of vulnerable persons. That's the line in the sand.
Then, for providers of general-purpose AI, think the companies making the foundation models, like GPT or Gemini transparency obligations, take effect in August 2025.
This mandates that foundation model providers must provide detailed summaries of their training data and comply with all copyright rules. Furthermore, all AI-generated content must be clearly and digitally marked as synthetic or manipulated. This addresses the deepfake threat head-on.
And finally, the most critical areas, the high-risk systems, like those used in critical infrastructure, medical devices, or law enforcement, face the most stringent requirements for risk management and quality assurance by August 2027.
The implication here is massive. This regulatory framework significantly increases the cost and complexity of compliance for all multinational tech companies. It mandates structural changes in everything from training data sourcing to internal risk management protocols, impacting the entire financial model Burry is currently analyzing.
So, to summarize the whole picture, we are living in a paradox. The underlying technological structure justifies the long-term vision of a $7 trillion productivity boom, but the market price is highly speculative, and the regulatory framework is struggling to keep pace with the acceleration.
Hawkers must be this. You need to fiercely differentiate between AI as a fundamental, irreversible productivity engine and the potentially overheated market expectations that Michael Burry is betting against.
Right. Burry is shorting the timing and the enthusiasm, not the technology itself. The macro environment desperately requires AI efficiency to escape the low-growth trap, but the stock prices may simply be years ahead of the actual return on investment timeline. Be smart, not emotional.
And as always, remember that we provide this objective data for discussion and analysis only. This is not personal investment advice. Please conduct your own independent research before making any financial decisions.
Excellent point. Now let's leave you with a final provocative thought that ties the governance risk and the technical speed together. We established that AI computing power has increased 55 million times in a decade and that global governance is currently paralyzed by ideological conflict.
The question is this: when will this massive deficit in clear, fast, and unified global rules lead to a major non-financial disaster? Perhaps a global disinformation crisis that destabilizes a major election, or an uncontained ethical catastrophe, something severe enough to truly force the hands of regulators and stop the technology train. That, more than any stock correction, is the next giant unknown risk facing the world.
That is the ultimate risk we must all start thinking about. Thank you to all our Sip and Talkers for joining us today. If you enjoy this blend of data and critical analysis, please remember to subscribe to Sip and Talk.
And while you're out there, go check out our old friend Mickey's YouTube channel, Mickytolife. He's got some fun memes and great travel vlogs that are perfect for decompressing after thinking about $7 trillion market opportunities and geopolitical breakdowns.
Catch you on the next one.
Bye-bye.